Hello, welcome to the Market Carver. I'm Adam Harter, Chief Investment Officer, along with Andrew Thrasher, Chartered Market Technician and Portfolio Manager. Thank you, as always, for clicking on this video, giving us a few minutes of your time. We're going to cover some of the things that we hit in yesterday, which would be Monday for us. We record this on Tuesdays. Investment allocation meeting. This week, we're going to talk about Fed cut expectations, a big meeting from the Fed. And then Andrew's going to hit us up with high momentum stocks and an update on some really extreme movements that we've had there. Before we get into the charts, though, just to set the stage a little bit, Fed meetings always carry weight around them in terms of how they're going to proceed. I think the setup there that I would give you is that 4 times a year, the Fed gives us what their projections for interest rates are going to be. And so since they met last December, that has been an expectation for 3 rate cuts this year. Since that meeting, we've seen the market be all over the place. We've seen them price in a lot more than that. I think at one time pushing 7 cuts. We've seen them now back all the way off. And so they're roughly matched coming into the Fed there. So an alignment between where the market thinks rate cuts will be and where the Fed thinks that they will be. The main thing to watch will be whether or not they leave those 3 on the table. There's essentially 2 ways they can go. They can leave those in place, and I think that would be the most dovish or the best possible outcome for those looking for lower rates. Or they could suggest, because we've seen inflation begin to heat up a little bit, the economy stayed strong, that there might be enough justification to back that off and maybe go to only 2 cuts this year or maybe more. So that's what we'll be watching. Of course, when you're watching this video, you'll already know the outcome. At this point in time, we don't. For me, one of the most notable takeaways is that historically, the Fed uses the media to their advantage. They like to get their message out, if possible, before they actually make an announcement. And they usually do that through the Wall Street Journal. Nick Timrose is currently the writer that delivers a lot of that news where they can set the table. And it was just notable to me in reading his preview that left it completely open. They weren't quite ready to put out there which way they were headed with that, which means it's quite possibly a very live and active and possibly, for if you're super nerdy enough like me, maybe even entertaining to watch how they actually come up with the rate cut. So that's what we'll be watching for this week. I would transition that into the chart we're going to show you here. Is one difference that we see is the Fed has been a very powerful driver, not just in what happens with bonds and interest related instruments, but it's also been a driver for stocks very powerfully over the past couple of years, with the backup in interest rates being pressure for stocks. This chart shows you the S&P 500, which is the blue line, pitted against the market's expected federal funds rate. It's on an inverted scale because higher rates often means lower stock prices, and conversely for lower rates. There's an inverted scale there on the right. So what we've seen over the past several Fed meetings is a very tight connection between what has happened in Fed rates and what's happened in stock prices. Of course, the rate hikes are a direct input into bond prices, but it's also been arguably the primary driver for the direction in stock prices. If you look at the action up through the early part of 2023, up even into late October, as the market was expecting more and more rate hikes, that put pressure under stocks. Then we saw a massive pivot by the Federal Reserve, not only pausing, but setting the table for future rate cuts. And that enabled, at least partially, for this big stock rally. But as we get into the middle and the early parts of this first quarter, what we saw is, again, the market begin to reprice in higher rates, but stocks able to continue their uptrend and continue that rally. So that divergence is certainly noteworthy, that there can be that untethering. So we perhaps are at a point where the Fed's not the primary game in town when it comes with stocks. That could be a good thing. Time will tell, of course, and we'll know more about that when we get the Fed rate outlook. Over the past several Fed meetings, the day and the day after the announcements, there has been strong performances both up and down, depending on which way those meeting results went, in asset prices. So perhaps if we could just get that to reduce its volatility, would be a good thing. But again, we'll be watching this in great detail and to be ready to provide you with more details next week. So Andrew, I'll toss it over to you and talk about stocks and the concentration we see in momentum.
All right, thank you, Adam. So last week, if you saw the market carver, the topic that I was discussing was looking at the Magnificent Seven, the biggest stocks in the market, the ones that have really been helping drive the market higher. And we were looking at the relative trends in price for the cap-weighted S&P 500, what we generally say with the S&P 500, where each stock is weighted based off the size of its market cap, and then an equal weighting of the S&P, where all the stocks get the same say, the same amount of weight within the index. And why that was important, why we want to look at how those MAG7 stocks, those biggest 7 stocks have been doing, is because we're starting to see that because they have such a large weighting, they also are showing up in other scans or other factors of the market. And that's the chart I'm bringing this week. And what we're looking at here is when we were to take all the stocks in the S&P 500, if we were to rank them all by who has the largest 12-month return. So over the last 12 months, rank each stock by how much it's gone up over the last 12 months, put them in order, and then we start looking at the ones at the top of that list with those largest 12-month rate of change. The majority of them are actually the largest stocks in the market as well. And that's not very common. Traditionally, you start seeing smaller stocks, ones that have less growth to grow their market cap because they're already smaller. It's easier to maybe double something that's $1 billion to 2 versus right now we have companies that are $1 trillion doubling to 2 trillion in some cases. Traditionally, it's the smaller stocks that you start seeing these really big returns. Right now, we're seeing the largest stocks with some of the largest returns. In fact, as this chart shows, going back to the early 1920s, that we're kind of in rare air right now. We're hitting a new all-time high in the number of stocks with the largest 12-month return also being the largest stocks within the market. The only other times we've really seen this was during the 1970s. If you remember that time period, the Nifty 50, where the market was really focused on just another handful of stocks. And we also saw this kind of going into the COVID period, because that's kind of when this whole theme started, where we started really starting to see the small number of stocks really start to break away from the rest of the market. And we've actually exceeded the last time during the dot-com bubble, when we saw this during the tech wreck in the 2000s, when just a handful of tech stocks were really going gangbusters. It was actually a lot of tech stocks were doing really well at that time. And then just things got kind of out in front of their skis, so to speak. And we saw kind of the result of that during the tech wreck. But we're at a place right now to where this identifies the market that we're in. We don't view this as a timing tool. We don't say this necessarily means the market has to top or bottom or where it's going to go from here. This is telling us the environment that we're in. We're in an environment where the biggest stocks have had the largest return, and that type of momentum can often be very hard to sustain. Traditionally, it's as if you were having a race car going around a track, and all the cars were going at the fastest clip they can, around and around, and that's sustainable for a period of time, but it also increases the risk. It also increases the possibility that something could go wrong. One car may hit the others and cause an accident. And that's kind of the market that we're in, where this could continue to go on for a period of time. Again, this doesn't tell us any timing issues, but it does tell us the environment we're in, where a lot of the stocks that are the most important to the market because of their weighting have also had the most considerable increase in price. And can they sustain that going forward? And that's where we're really paying a lot of attention. So far, they've shown us they have been able to sustain that growth and sustain that trajectory and that momentum. And we continue to watch going forward to see how long that can sustain itself, or we start seeing the market starts to rotate significance or importance to other factors of the market, other sectors or other industries and stocks. And if we start seeing that rotation and try to capitalize on that and look for opportunities within the portfolio, and then also just recognizing the impact that would have on the broad market as a whole. So very interesting. We haven't seen this type of market environment in a very long time. And so we're kind of in, like I said, kind of in thin air right now, to where we're hitting new all-time highs, and the stocks that are the largest also being the stocks that have gone up the most.
Excellent. Thank you, Andrew. And thank you, as always, to all of you for giving us your time here, especially because in this time period here, we've got 4 days of the best 4 days in all of sports, in our opinion, 4 days of wall-to-wall basketball. So if you're taking a few minutes of your time to watch during this, we greatly appreciate it. As always, we give you a reminder here to give us a call, and we can be a service, 800-928-4001. We'd love to hear from you, or scan the QR code and book us electronically. So thanks again. Have a great weekend and enjoy some good basketball.